Hi, welcome to the second episode in this special series as we look at the key issues that we need to understand, especially in the accounting standards to be able to pass the examination. Now we want to get excited into the discussion and start with the grandpapa of all accounting standards, and that is IAS 16 property, plant, and equipment. Like I mentioned in the first episode, we are going to be making a reference to the Institute of Chartered Accountants England and Wales corporate reporting manual because of the fact that there are a couple of questions in there that I want to discuss with you, and I don't want that to conflate with the questions that we will be solving in class from our question kit or that are included in the book. So I want to come in from another aspect so I help you well to understand the way all these standards must be treated. Like I said, pay attention. Make sure you understand the principles, and as we go through the questions, make sure that you put yourself in it to increase your chances of ultimately passing the examination. Because the accounting standards, I can guarantee you, are not difficult as you think. Are you ready? Let's go. So, IAS 16, property, plants, and equipment. What do we have to know about this standard? Pretty simple. Let me bring up my slide. Under property, plants, and equipment, there are some definitions that we have to also be mindful of, and these definitions will help us later on and throughout our discussion. So, make sure you stay with me carefully. The first one is cost. When we say the cost of an asset is, say, $10,000, what do we mean? Cost is the amount of cash or cash equivalent paid or the fair value of other consideration given to acquire an asset at the time of its acquisition or construction. What does that mean in principle? Very simple. It means that we will look at what constitutes the cost of an asset in a moment. But if an entity is going to buy an asset, how much does the entity pay to acquire the asset? That could be the cost of the asset. Two, residual value is the estimated amount that an entity will currently obtain from disposal of the asset after deducting the estimated cost of disposal. If the assets were already of the age and in the condition expected at the end of its useful life. Fair value. Fair value can be defined as the price that will be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. Next is going to be carrying amount. When we say the carrying amount of an asset, what do we mean? The carrying amount is the amount at which an asset is recognized after deducting any accumulated depreciation and accumulated impairment losses. So in our books, and this is usually on subsequent measurement. So in our books, the carrying amount of an asset, which can also be carrying value, is going to be the cost of the asset or the fair value of the asset minus any accumulated depreciation or impairment loss. That is the idea about the carrying amount. Now, you will realize then that in arriving at the carrying amount, two things are coming in, and that is the issue about depreciation and impairment. Now, what is depreciation? In a simple language, we say that depreciation is simply the allocation of the cost of an asset over its economic useful life. And there are various methods of depreciation that you have to be mindful of when it comes to dealing with IAS 16 property, plants, and equipment. We have the straight line method, we have the reducing balance method, we have the production unit method, and then we have the sum of year digits method. I may not talk about all of them in this session, but in subsequent sessions, as we solve questions, we're going to be dealing with some of them. But in the straight line method, it is where depreciation is going to be charged on the cost of the assets. What does that mean? It means that the same amount of depreciation is charged over the economic useful life of the assets. So by method, we say that depreciation can be equal to the cost of the asset multiplied by percentage of depreciation, because sometimes in a given question, the examiner will tell you that depreciation is 20% straight line, 25% straight line. So if the examiner says depreciation is 20% straight line and the cost of the asset is 20,000 and depreciation is 20% straight line, what does that mean? It means that in principle, our depreciation for the year is going to be $20,000 multiplied by 20%. And that is going to be an amount of $4,000. I hope you are getting it. So sometimes we can be given a percentage, but the examiner will say on a straight line basis, and you apply it on the cost of the asset. Alternatively, the default way to calculate depreciation is to use the economic useful life. And so this is where we can bring the cost minus scrap value divided by the economic useful life of the asset. In this approach, in the question, the examiner will give you the cost of the asset, say 10,000. The examiner will give you the economic useful life of the asset, say 5 years. If we are not given the scrap value, then in this case, our depreciation will be, say, 10,000 divided by 5 years, and that is going to be $2,000. And that is how we calculate depreciation on the straight line. But let me put this up to you that sometimes depreciation must be charged on a pro rata basis, that is 1 month ownership basis. What does that mean? It means that if the year ended of the company, it's say 31st October, and the entity bought an asset on 1st July 2020 or 1st July 2022, and the year ended of the company is 31st October 2022, then the question we need to ask ourselves is, how long has the entity used the asset in the current year ended? July, August, September, October, 4 months. So it means that in this specific scenario, we would have to calculate the depreciation on a 4 months ownership basis. For that reason, the calculation of the depreciation may have X over 12 coming in. X means the number of months that we have used the asset in the current year ended under review. And if it is not a full year, that is where the X over 12 will come in. That is the concept about the straight line method of depreciation. The second thing is going to be the reducing balance method. In the reducing balance method, what happens is that depreciation for the year is calculated on the carrying amount of the asset. On the carrying amount of the asset. What does that mean? It means that here the depreciation charge reduces as the asset ages. So in this place, we will have our depreciation for the year to be equal to the carrying value multiplied by the percentage of depreciation. And if it is less than a year, X over 12 will come in. Okay, so if I go back to my illustration here, in the reducing balance, let's assume that the cost of the asset is $10,000. Depreciation rate, so depreciation on reducing balance basis, let's say 25%. And so let's assume that the year ended of the company is 31st October 2022. And let's say that the asset was acquired at, so acquisition date on 1st March 2022. Okay, so just using that as a guinea pig for my illustration. So what's going to be happening? We need to get a carrying amount for the year ended 31st October 2022. So what do? We present. We bring in the initial cost as at 1st March 2022, and that's $10,000. Then we're going to less the depreciation for the year. Be careful because, like I said, we're going to be using the pro rata 1 month ownership basis. So if the asset was bought on 1st March, and our year ended is 31st October, March, April, May, June, July, August, September, October. 1, 2, 3, 4, 5, 6, 7, 8 months. So our depreciation for the year ended is going to be $10,000 times the percentage of depreciation, which is 25%, 8 over 12. So let's punch that out and see what we are going to have. 10,000. 0.25, 8 over 12. And I'm getting maybe 1667. And so we less that, and that gives us the carrying amount at the reporting date at 31st October 2022. So 10,000 minus 1667, that's 8333. So in the year one, that is the year ended 31st October, This is the amount that will go to the statement of profit or loss, and this figure, the carrying amount, will go under property, plant and equipment, non-current assets on the face of the statement of financial position. Now, let's assume nothing happened to this asset, but how do we calculate depreciation in the second year? So we will less depreciation for the second year, and that is the year ended 31st October 2023. Like we said, in the reducing balance, depreciation is charged on the carrying amount. So now in the subsequent year 2023, we will calculate depreciation using the carrying amount, which is 8333, and that will be multiplied by the 25%. Okay? So my answer by 0.25, and that is 2024. So we less that, and that gives us the carrying amount at the end of 31st October 2023. And so 8333 minus 2024, and that is 6309. 6309. So that becomes the carrying amount in 2023 year ended. So that is the reducing balance method. Now, if we were using straight line method, it would have been a different story if the same question, but it's a straight line method. So we're going to have the initial cost still coming up as 10,000, but we're going to less the depreciation. Again, I'm assuming that the percentage here is the same, but it's a straight line method. So that way we're going to have 25% on the 10,000 times 8 over 12. Fortunately, it's going to be the same answer, 1667. And so the carrying amount is going to be this figure. Then in the year ended 2023, so in the year 2023, remember in straight line method, depreciation is charged on cost. So in 2023, we'll still do 25%, but on the cost, 10,000. That's a full year depreciation of 2,500. So 8333 minus 2,500, and that gives us 5833. That is the idea about the straight line method, and that will be the carrying amount for the year ended 31st October 2023. Okay, so that is the difference between the straight line method and the reducing balance method of depreciation. But there is also another one called the production unit method. So let me explain that also to you. The production unit. The concept about the production unit method is what it sounds like. So here, depreciation is charged based on the production units from the utilization of the asset. So with the production unit, depreciation is charged based on the production units from the utilization of the asset. What does that mean? It means that here we go through some steps. The first one is that once the asset is bought, now these are, assets used in the production system of an entity, and the output can reliably be measured. If that is the case, then what will happen is that we'll calculate the depreciation rate per unit, and that is going to be the initial cost of the asset divided by the total production unit over the economic useful life of the asset. So what is then going to happen is that our answer is going to be whatever, X Ghana cedi or X dollars per unit. So once we calculate the depreciation rate per unit like that, the annual depreciation or depreciation for a specific year ended will be the depreciation rate per unit multiplied by production units. So this same concept can also apply in terms of hours. So sometimes the output from the usage of the machine or the assets cannot be reliably measured. In that case, we will use the hours to be able to calculate the depreciation. So alternatively, we can also use the machine hours to charge the depreciation. So there are a lot of methods or approaches available that can be used to depreciate assets. The most important thing is to know the principle underlining each of the methods. So that is the idea about arriving at the carrying amount, the cost or the fair value minus accumulated depreciation. The issue about impairment is under IAS 36, and we'll talk about that later on in the discussion. So these are some core issues that we need to understand when it comes to dealing with property, plant, and equipment.